A client came to us last year convinced their business was doing great. Revenue was up, sales were strong, and they were hiring. Then we looked at their books. Turns out they had been losing money for 6 months straight and they had no idea. If your business is somewhere between $3 and $10 million in revenue, this video might save you from that exact situation. The bookkeeping system that got you to $1 million may break when you try to get to 10. And if you don't fix it, you'll not just stay stuck, you'll actually start moving backwards. Today, I'm going to walk you through 4 costly bookkeeping mistakes we see constantly in growing businesses. The 4th one is the sneakiest. Most business owners do not catch it until it has already cost them tens of thousands of dollars. Mistake number 1, you've outgrown your bookkeeper, but you don't know it yet. We had a client running a professional services firm, about $3 million in revenue and growing fast. Their bookkeeper had been with them since the beginning, loyal, hardworking, and knew the business inside and out. The problem was that the bookkeeper was trained to categorize transactions and reconcile bank accounts, basic stuff. They weren't trained to handle accrual accounting or revenue recognition across multiple service lines or deferred revenue from retainer clients. The books looked fine on the surface, but underneath, revenue was being recognized in the wrong periods, expenses were misallocated, and the owner was making growth decisions based on financial statements that were almost fiction. By the time they came to us, they had overhired by 3 people because they thought they had more cash runway than they actually did. Your bookkeeper is not the problem though. The mismatch is the problem. A business doing $1 million a year likely has different financial complexity than one doing 5 million, and 5 million different from 10 million. So if your bookkeeper can't explain the difference between cash basis and accrual basis accounting, or doesn't know what deferred revenue means for your business, that's probably a red flag. That mistake is painful, but this one might be more common. Mistake number 2 is you're using the wrong tools or the right tools wrong. Many businesses start on QuickBooks. It makes sense, and it's a solid platform for small operations. But then the business grows. They open more offices, they start selling in multiple states, they bring on contractors, or maybe they launch a second revenue stream. And instead of upgrading their financial infrastructure, they just bolt things on. Spreadsheets everywhere, manual workarounds. Someone on the team becomes the only person who understands how everything connects. That's a single point of failure waiting to happen. One client came to us spending 15 hours a week just reconciling their books across different systems. 15 hours. That's nearly 2 full workdays every single week on something that should be automated. When you cross $1 million in revenue, you need to start integrating your system. Your accounting software should talk to your revenue recognition system, your expense management platform, and your payroll. If you're manually moving data between systems, you're not just wasting time, you're creating opportunities for errors that compound month after month. And at some point, you need to ask whether you've outgrown QuickBooks entirely. If your business is approaching that $5 to $10 million mark, or you have multiple entities, or you're dealing with complex revenue recognition, QuickBooks starts to hit the ceiling. That's when platforms like Sage Intacct enter the picture. Sage Intacct is a true cloud ERP built for growing mid-market companies. It handles multi-entity consolidation, dimensional reporting, and automation at a level that QuickBooks simply cannot match. But you do not upgrade just because you can, you upgrade when the cost of your current system's limitations exceeds the cost of switching. So what does that look like in practice? If your finance team is spending more time building workarounds and actually analyzing data, that's a sign. If you can't get consolidated financials across multiple entities without a week of manual effort, that's another sign. If your auditors keep flagging same control weaknesses because your system can't enforce proper approval, that's a sign. The move to an ERP like Sage Intacct is not about having fancier software. It's about having infrastructure that matches your complexity so your team can focus on insight instead of data wrangling. Now, those 2 mistakes are about infrastructure, people, and technology. These next 2 are ones that silently drain your bank account while you think everything is going fine. Mistake number 3, your books are always behind. Right now, today, do you know exactly how much profit your business made last month? Not revenue, profit. If you had to wait even in a few seconds to think about that, we have a problem. When your books run 60 or 90 days behind, you're just making decisions in January based on what your business looked like in October. I had a client in e-commerce, a seasonal business. Revenue spikes in Q4, then drops in Q1. They were looking at their October numbers in December, feeling great, and approved a big inventory purchase for the spring. But by the time their December and January numbers came in, they realized their margins had gotten crushed by shipping costs and returns they hadn't accounted for. So that inventory purchase nearly broke them. Real-time financial visibility isn't a luxury anymore. At your revenue level, it's a requirement. You should be closing your books within 10 to 15 days of the month end max. If that sounds impossible with your current setup, that's a sign that your setup needs to change. The fourth mistake is the sneakiest. It doesn't show up on any report, you won't see it in QuickBooks, and your bookkeeper might not even know to look for it. Mistake number 4 is you have a bookkeeper when you need an advisor. There's a difference between someone who records what happened and someone who helps you understand what it means. A bookkeeper will tell you that your revenue went up 10% last quarter. An advisor will tell you that your revenue went up 10%, but your profit margin dropped by 3 points, and here's why that happened and what you can do about it. A bookkeeper categorizes expenses. An advisor notices that your cost of goods sold has been creeping up for 6 months and asks if you have renegotiated vendor contracts lately. A bookkeeper or a tax preparer will just file your taxes. An advisor looks at your business structure 6 months before tax season and identifies that switching to an S Corp could save you $40,000 in self-employment taxes. At the $3 to $10 million revenue level, the difference between recording and advisor can be worth 6 figures easily. Most business owners at your stage are paying for data entry when they should be paying for insight. If your business is in that $3 to $10 million range, these are the 4 bookkeeping mistakes that can cost you the most. 1. Having a bookkeeper who has not grown with your complexity. 2. Using patchwork technology that creates manual work and errors. 3. Running your books so far behind that you're flying blind. And 4. Settling for transaction recording when you need strategic financial insight. Fix even one of these and you'll see the difference in your bottom line. Fix all 4, you've gotten a financial foundation that actually supports growth instead of holding you back. If you recognized your business in any of these mistakes, that is exactly what we help business owners sort out. We're Proseer. We provide concierge-level accounting and tax advisory for entrepreneurs who have outgrown the basics. The link is in the description if you want to talk through where you are and where the gaps might be. And if this was helpful, subscribe. We put out content like this regularly. Thanks for watching.